Why capital gains tax is wrong. Capital gains tax takes wealth away from average people. We hear the subject of capital gains tax frequently discussed in the media. In April 2024, Forbes reported that President Biden was proposing a 44.6% capital gains tax. Forbes also reported in September 2024 that presidential candidate Harris is proposing a 28% capital gains tax, but also wants the tax to apply to wealthy individuals on unrealized gains. Are these taxes reasonable? Do they make sense? Should we have these taxes? These are all valid and important questions. Something I have learned over the years is that many of my friends and colleagues, even well-educated ones, don't understand capital gains. The purpose of this article is to explain capital gains and why capital gains posses a challenge to both taxing authorities and logical thinkers. Notice that I differentiate between the two because anyone who has ever studied the tax code knows that it is anything but logical. So let us look at capital gains. What are they? Investopedia.com provides the following answer. A capital gain refers to the increase in the value of a capital asset when it is sold. It occurs when you sell an asset for more than what you originally paid for it. Almost any type of asset you own is a capital asset. This can include a type of investment, like a stock, bond, or real estate, or something purchased for personal use, like furniture or a boat. Capital gains are realized when you sell a capital asset by subtracting the original purchase price from the sale price. Capital gains occur when we sell an asset for more than the purchase price. That is simple to understand, so let us move from textbook definitions to real-life examples. In our example, we will use Carol and Bob, husband and wife. Bob is a middle manager for a national freight company, and Carol works in admissions at a local hospital. Even though Carol and Bob have 3 children, they are extremely frugal. They drive old cars, they go camping for vacation, they rarely eat at restaurants, and they buy clothes at Walmart. Carol and Bob have a household income of about $150,000, but because they are frugal, they can save $50,000 per year. After 5 years, Bob and Carol have saved $250,000. At this point, we should mention that the $250,000 that Bob and Carol saved was saved with after-tax dollars. What does that mean? It means that in order to save $250,000, Bob and Carol had to earn anywhere from $300,000 to $350,000 and pay anywhere from $50,000 to $100,000 of that to the government in taxes. Remember, in addition to federal income tax, many states have income tax, and many of the products Bob and Carol purchase for their family have federal and state excise taxes, state sales tax, or both. So, taxes have already been paid on the money Bob and Carol have saved. Bob and Carol decide to buy a house and rent it out. Fortunately, they don't live in California, but in a part of the country where you can still buy a house for $250,000. They buy the house, rent it out, and then pay taxes on the income the house earns. The house has 3 bedrooms, 2 bathrooms, and is about 1,600 square feet. 5 years go by while Bob and Carol save the income from the rental property with the hopes of buying another rental house. At the end of 5 years, Bob's employer gives Bob a small promotion and transfers Bob to another small town in another state. Bob and Carol sell the house where they live, and they also sell the rental property. However, the rental property has increased in value, so they sell it for $450,000, a gain of $200,000. Under our current tax code, Bob and Carol will have to pay 15% tax, or $30,000, on their capital gain. That means Bob and Carol will be left with $420,000. When Bob and Carol get to the new town, which has housing prices very much like the old town, they find that similar houses to the rental house they sold sell for around $450,000. Now they are $30,000 short. They cannot replace the asset they sold with the money they have left over after taxes with a similar property. I am ignoring 1031 exchanges in this example because 1031 exchanges are only good for real estate assets and then not necessarily application in all real estate transactions. We must ask, did Bob and Carol really gain anything? And why did the price of their rental house increase? House prices go up for 3 reasons. First, inflation. The value of the dollar decreases, so the price of any real asset increases. Second, government regulation. It is costlier to build a house, so the value of all houses increase. Third, restrictions on supply. The population increases, but when not enough housing is built, demand exceeds supply and prices go up. One of the major reasons we don't build enough houses is government restrictions on building and development. Bob and Carol are now worse off than they were just a few months prior because of the government's monetary, building, and development policies have caused home prices to increase. But when they sell their rental house, the government takes 15% of that, so they are not even able to replace the house they just sold. And both Biden and Harris have proposals that would significantly increase the amount of tax Bob and Carol pay on the increase in value, leaving them with even less money to replace the asset they sold with a similar asset. Let's summarize what I have just said for clarity. Primarily due to government monetary, building, and development policies, the price of a rental house will go up, but you don't really gain anything. You still have the same rental house. If you sell that rental house, you will not have enough money left after tax to purchase a similar property. And remember, you already paid taxes on the money you used to buy the property in the first place. Now Biden and Harris want to tax you even more, so you will have even less cash to replace the asset with something similar. You might ask about capital gains for people whose business is to trade in capital assets, like buying and selling stocks and bonds on a daily or weekly basis. Those people pay what is called short-term capital gains. Short-term capital gains are taxed as ordinary income. In other words, you pay the same tax on short-term capital gains as you do on the paycheck you earn from your employer. There is an argument that short-term capital gains arise from trading in and out of assets, and that really is a business activity and different from the example we used for Bob and Carol. Further, assets like stocks and bonds can increase in value based on such things as economic outlook and financial performance of the business, as opposed to just inflation. Even then, however, some of the increase in value is the result of government policy, including the money supply, tariffs, industry regulations, subsidies, international policy, and more. There's an argument that would suggest, even for assets that are traded regularly and subject to ordinary income, at the time of the sale of the asset, the person selling the asset is no better off than when that person purchased the asset, because it would cost that person the same amount of money to replace the asset with one similar to it. If I sell 100 shares of Apple stock that have increased in value by 50%, and a week later I decide to buy it back, taking tax into account, I will not have enough money to repurchase it. Again, we need to stress in the whole analysis that Bob and Carol's investment was made with after-tax dollars. They already paid the tax on the money they used to invest in that rental property. Further, as I have discussed, when you sell an asset that has increased in value and you pay the capital gains tax on that increase in value, you don't have enough money left to replace the asset you just sold. In effect, the government is coming along and arbitrarily taking a piece of the asset you owned and leaving you in a situation where you do not have enough money to replace that asset with an asset of like kind. Remember, the economic value of the capital asset in Bob and Carol's case did not increase. The home didn't miraculously add rooms or square footage. It was the same 3-bedroom, 1,600 square foot home when they sold it, as it was when they purchased it. And let us stress again that in many cases the increase in the value of a capital asset can be attributed to monetary and other policies of government. So, the government sets the stage for the selling price of your asset to go up, and then when you sell it, they take a significant portion of the increase from you, leaving you in a situation where you can longer replace the asset you just sold. This is what some politicians call fair. I think it is a rip-off by the government that amounts to theft. Maybe if the government didn't tax capital gains, average folks could invest in capital assets and help to build family wealth to pass on to their heirs.